Ladies and gentlemen, good day and welcome to Datamatics Global Services Limited Q3 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Asha Gupta from Christensen IR. Thank you, and over to you, ma'am.
Thank you, Lizanne. Good afternoon to all participants in the call today. Welcome to the Q3 FY22 earnings call of Datamatics Global Services Limited. The results and investor presentation have been already mailed to you, and it is also available on our website www.datamatics.com. In case anyone has not received the copy of press release and presentation, please do write to us and we will be happy to send it to you all. To take us through the results and to answer your questions, we have with us the top management of the company represented by Mr. Rahul Kanodia, Vice Chairman and CEO, and Mr. Sandeep Mantri, Chief Financial Officer. Mr. Rahul will start the call with brief overview of the quarter on the business, which will be then followed by the financials, which will be given by Mr. Sandeep. We will then open the floor for Q&A session. As usual, I would like to remind you that anything that is said in this call which gives any outlook for the future or which can be construed as forward-looking statement must be viewed in conjunction with risk and uncertainties that we face. These risks and uncertainties are included but not limited to what we have mentioned in the prospectus filed with SEBI and subsequent annual reports, which you can find it on our website. With that said, I now hand over the call to Mr. Rahul. Over to you, sir.
Thank you, Asha, and good afternoon, everyone. Welcome and thank you for joining our quarter 3 2022 earnings call. Let me start by wishing you all a very happy new year and a safe 2022. I am glad to share that we have reported another stable quarter and we were able to sustain margin performance despite the sourcing and supply side issues that we are all facing across the IT industry. The prolonged strong demand environment, especially in the newer digital technology, has forced large-scale hiring of freshers. During the quarter, we added 541 net additions, taking our total headcount to 11,089. In quarter 3 of 22, our annualized attrition rate stood at 29% versus 27% in the previous quarter, and should remain in the range of about 30% for this year. We have ramped up our hiring process and will continue to invest in hiring, training, and upskilling all our employees. Coming to the quarter performance, our revenue growth remained stable. Excluding Signex, which was a subsidiary we divested in FY 2021, that's quarter 4, we have grown 14.8% on a year-on-year basis and have grown a 0.5% on a sequential quarter basis. Despite resourcing and supply side pressures and have increased salaries, we have sustained EBITDA margins of 16.8%, a growth of 460 basis points on a year-on-year basis, excluding Signex, and 396 basis points including Signex. Now, if you notice, we have had over the last 2 or 3 years, we've moved from an EBITDA at a company level of 9.7% in 2017 steadily to 16% for the third quarter as of this financial year. So we've steadily improved our margins quite a bit. Traditionally, our quarter 3 results have always been softer than quarter 2. And we have seen the same this year. Although this year it was weaker than usual. Our expected growth for quarter 4 on a sequential basis would be around 3%. We are seeing a significant traction in our BPM business, which contributes 55% of our revenues and grew at 13.7% on a year-on-year basis. BPM EBITDA margins were at 23.1%, and the growth was aided by an expansion of business from existing customers and continuous effort on cost optimization. Our IT revenues, which contributed 45% of our total revenue, grew at 1.1% on a quarter-on-quarter basis. Our IT EBITDA margins was at 13.4%. However, after factoring in the investment in products, our margins stood at 9.1% for the quarter. Over the years, our IT margins have also moved up. If you look at the last 4 quarters in particular, we moved up from 4.7% to 9.1%. And likewise, the EBITDA margins on the BPM side in Q1 of 21 stood at 10.1%, which has steadily moved up to 23%. We presently have over 500 open billable positions in IT. The current environment of high attrition, high salary expectations, and very high dropout ratio is hindering us from encashing these opportunities, which is of course reflected in our growth. We saw several deal wins during the quarter across IT and BPM. We added 34 new clients this quarter. In Q3, we signed a total contract of about $85 million, of which there were 3 large deals ranging between $15 million and $30 million, spread over 3 to 5 years, plus several other deals totaling to about $15 million to be executed over the next 1 to 2 years. I'm glad to share that recently we were awarded the automatic fare collection contract from Delhi Meerut Corridor by NCRTC and the Kolkata Metro by Rail Vikas Nigam Limited. Both of these are fare collection projects where we are doing the automation of ticketing systems and fare collection for the metros in India. Additionally, we also entered into a long-term strategic partnership with a global leader in workforce solutions for providing digital customer management solutions. All these large deals, all three of them, which is about $70 million, will kick off from the next financial year. So we will see no impact in this financial year, and they will all last between 3 to 5 years. We are witnessing a strong demand environment across sectors we operate in. To capture these opportunities, we are ramping up our marketing and pipeline generation activities and have realigned our sales team with a sharper focus dedicated to each of our business units. Datamatics has a healthy pipeline of over $100 million. This includes a product pipeline of about $12 million, where we will be closing a few good deals this quarter. Based on the pipeline and large deals signed last quarter, we are confident and expect to have a growth of about 15% in the next financial year. The silver lining for us is that the overall industry continues to go through a large-scale digital transformation, and at Datamatics we are very well positioned to capture these opportunities. To conclude, going ahead, we are very positive about our overall demand environment and are confident of our growth for the next quarter at 3% and next year at 15%. With that, I will now hand over our call to our CFO, Sandeep Mantri. Sandeep, over to you.
Thank you, Rahul. Welcome everyone, and thank you for joining us on our Quarter 3 FY22 earnings call. I hope that all of you are safe and healthy. Wish you all a very happy new year. Let me start with the key financials for Quarter 3 ended on December 31, 2021, and then I'll take you for the 9-month result. So our net revenue for this quarter was at 300.8 crores, marginally up by 0.5% on a sequential basis and flat on a YOY basis. However, if we remove Signex from our last year number, which we divested, then we have grown at a 14.8% on a YOY basis. And our ratio of IT and BPM was at 45-50 in the quarter. Our BPM revenue for the quarter remained stable at 164.7 crores on QOQ basis and grew by 13.7% over last year's same quarter. Our BPM EBITDA margin was 23.1% for the quarter, which is 237 basis point up on a YOY basis. Our IT services revenue for the quarter was at 136 crore, which is a growth of 1.1% on a sequential basis and decline of 14% on year-on-year basis, but the decline was primarily due to Signex divestment, which we did in Quarter 4 of FY21. If we remove impact of Signex divestment, then actually we have grown 16.2% on a YOY basis. Our IT EBITDA margin was at 9.1%, but without product spend, it remains at 13.4% for the quarter. Our consolidated EBITDA grew by 30% on a year-on-year basis, while without Signex, it was up by 58% on a year-on basis. Our consolidated margin for the quarter was 16.8% as compared to 12.2% in Quarter 3 of last year and 16.7% in last quarter. So we were able to maintain double-digit EBITDA margin, mainly due to our constant effort on cost optimization and automation, along with price increase in some of our customers. This was despite headwind due to increased salary and supply side pressure in our IT business side. And as mentioned by Rahul, we have taken several measures to get future ready and avoid any business losses due to the supply side challenges. Overall, industry is also facing this issue, and we are not different from the situation. However, we are confident of maintaining a double-digit EBITDA margin for the rest of the financial year. When we talk about PAT, which is after non-controlling interest, PAT is at 36.9 crore, which is a growth of 4.7% on a quarterly basis and a growth of 67% on a year-on-year basis. In fact, without Signet, our PAT was grown by 93.4% on a YOY basis. Our EPS for the quarter was at 6.27 per share, which is higher than last year's same period, which was at 3.76 per share. Our tax rate for the quarter remains at 24.2%, which is same like last quarter and also last year quarter. These were quarterly numbers. Now coming to 9 months FY22 numbers, our revenue was at 87.7 crores, including Signet. We reported a growth of 2.5% on a YOY basis. Without Signet, we reported a growth of 20% on YOY basis. Our EBITDA stood at 141.8 crores, which is a growth of 41.2% on a YOY basis. If we exclude Signet, then this growth is 75.5%. Our EBITDA margin for 9 months FY22 was 16% as compared to 11.6% in last year, which is 438 basis point increase from the previous year margin. The growth is primarily driven by our disciplined execution and cost optimization measure. Our PBT, profit before tax and before exceptional items, stood at 130.4 crore, which is a growth of 134% on a YOY basis without Signet. However, PBT after including exceptional item on account of one-time exchange gain of rupees 10.2 crore was at 140.6 crore, which is a growth of about 152.1% excluding Signet. Our EPS stood at 18.98 per share as compared to 8.67 per share in the same last year same period. Our YTD tax rate remains YTD adjusted tax rate remains for 9 months at 23.1% as compared to 26% in previous year period. So there is a slightly lower tax rate in this 9 months. When we talk about balance sheet, we continue to remain healthy. As on December 31, 2021, our total cash equivalent plus liquid investment stood at 372 crores. Our free cash flow to PAT was at 13.8%. Our DSO was at 64 days as of December 31, 2021. And we continue to remain cautious on the new variant of pandemic and are confident of combating challenges and maintaining growth momentum. In terms of geographical footprint, the US is 54% of our business, while India is 25%, UK and Europe is 16%, and the rest of the world is 5%. In terms of industry footprint, BFSI continues to remain largest segment for us, which is 32% of revenue, followed by education and publishing, which is 23%, then technology and consulting, which is 17%, manufacturing, infra and logistics is 9%, then retail is 7%, and not-for-profit or government organization is 7% of our business. Rest, all other are 5% of our total revenue. Our client concentration remains healthy, with top 5, 10, 20 clients contributing to 27%, 41%, and 53%. We added 34 new clients in the quarter. Our total headcount for the quarter was 11,089. So these are the basically financial summary for the quarter. With this, I will now pass on the call to operator to open the floor for Q&A. And thank you very much for your patience, and I appreciate your continued interest in Datamatics. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Faisal Hawa from SJ Hawa & Co. Please go ahead.
Okay.
Mr. Faisal Hawa, we are not able to hear you.
Yeah. Can you hear me now?
Sir, your voice is breaking up.
Can you hear me now?
Sir, it's not clear. Your audio is not clear.
One minute. Wait. Hello? Hello?
Yeah, we can hear you.
Hello?
Hello, we can hear you.
Hello? Can you hear me now?
Yeah. Yes, we can hear you.
So can you give me around...
Sorry to interrupt, Mr. Hawa. We are not able to hear you at all.
You're looking at amount on account of salary hikes, etc. Because we are a smaller organization, so other opportunities for growth are not too much for our employees.
Sorry, Mr. Hawa, we could not hear your question. So we really...
Hello, can you hear me?
Yeah, it is breaking. You're audible, but it kind of comes and goes.
Yeah. I mean, the networks are... Hello?
Yes, we can hear you.
Yeah. So, can you give me, some steps that we have taken that, to attrition definitely is an industry-wide problem, but how we can retain the employees, because for larger organizations, the opportunity for growth and learning and relearning are much better. So how will we, really, retain our employees in this kind of a scenario? And are we taking any steps to, increase our business in USA and Europe?
Yeah, so I'll answer the second one first. So we have increased our sales team both in USA and Europe. We've also augmented the marketing team and the lead generation team substantially for these geographies. So yes, to your point, we have augmented that, and we should see a stronger growth in Europe and the US for next year. Coming to your first question in terms of employees, typically what we do is in smaller organizations, you give employees a higher level of responsibility that empowers them. In larger organizations, they kind of get lost in the hundreds of thousands of people that are there. So employees do enjoy the liberty, the flexibility to take responsibility and deliver on their own. So of course, apart from that, occasionally you do have to factor in the salary increases that we have to give to maintain a certain level of parity. So if you see our attrition at 30% is high, but it's not so high. I believe Infosys is also somewhere in the range of 25%. So we are not so way out vis-a-vis the industry or vis-a-vis some of the larger competitors. However, the dropout ratio is right now extremely high.
If you were to name just three verticals where you feel that the growth will be tremendous within the IT services, which would be the three verticals, and any steps we have taken to really augment our growth in those verticals?
Yeah, so BFSI and manufacturing would be the dominant verticals, and as I said, we've increased our sales activities in those segments, and we should see results because both of these lend themselves very well to automation and robotics and things like that. So and they are large spenders on technology, and today technology is driving all businesses. So these are the large ones we focus on, and we are seeing good traction there.
Okay, sir. Thank you so much.
Thank you.
Thank you. We'll move on to the next question. That is from the line of B. Chetan, a private investor. Please go ahead.
So I have a question for Rahul. So Rahul, you talked about 3% growth for the next quarter. So I just wanted to ask, how confident are you about achieving it given the current state of the economy?
Yeah, given the pipeline and given the deals that we signed, I'm confident that we will hit that number for the quarter, for Q4 that is.
Yeah, about the pipeline, you mentioned that you have a $100 million pipeline. So how much out of you think you'll be able to close?
Statistically speaking, we should close between 25 to 30 million as per our past track record and performance and conversion ratios are concerned. The conversion ratios are much higher for existing customers and lower for new logos. That's always the case. Existing customers tend to range between 60 to 80%. Newer logos tend to be about 20 to 40% perhaps. So statistically speaking, we should close around 30 million out of the 100 million.
Okay. Thank you for your answer.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Gopal Agarwal, an investor. Please go ahead.
Thank you for giving me the opportunity. So I was wanting to know regarding to this contract, Delhi Meerut Corridor that you were explaining. So I was curious to know when we expect revenue to start flowing from this particular thing. And also, are we eyeing more contracts of similar kind under this AFC? So that was my first question.
Okay, so let me answer that. So the Delhi Meerut corridor will start from beginning of next year, and this is a primarily 5-year contract with another 5 to 6 years of maintenance post implementation. So most of the revenue of Delhi Metro contract will get accrued in next 3 to 4 years. So from April onward next year, and this contract is a large size for us. So this should give us upside on margins as well.
Okay, thank you. Also, if you see, given we have decent cash in hand, so are we planning for any M&As, etc.? And also, I would like you to provide some color on dividend payout policy, and if you're planning to pay any dividend for this particular fiscal year.
Sure. So M&A, as far as M&As are concerned, while there are no serious or more active discussion, but right now we are discussing with many companies. We will let you know whenever it comes to a certain point where we are sure about all those M&A. And then on this
overall, we are in dialogue with about 7 to 8 companies, but these are all early stages.
Initial stages discussions.
So as they mature, we will certainly reveal to the appropriate authorities. As far as dividend policy is concerned, this year, as you know, we have declared an interim dividend. Final dividend, I think it depends on the board. Once we close the year, the board will sort of review and take a decision and make a recommendation.
So dividend decision mostly will be in annual board meetings, most likely.
Thank you, sir. That was all from my side.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Danish Mistry from Investor First Advisors. Please go ahead.
Hello, good afternoon, and thank you for taking the time out to talk to us. So I basically, 2 questions. One was, this time your Q-on-Q growth was just about flat, 0.5% QOQ. So anything to read into that? Is it just some projects rolling off, or like last time, did we, are we seeing some customer attrition? That's number 1. And number 2 is regarding, you've answered in a way what the previous caller asked on employee attrition. But if you were to see, our employee cost is about 20 crores today, and we've also spoken about expanding in different geographies. So obviously that would require us to raise sales headcount, as well as we could be obviously facing some wage pressure here. So how do you see that panning out, and are we in a position to pass on those costs to our customers? Thank you.
So in terms of passing on the cost, we cannot pass on sales costs, but we have been able to reprice our services. Mm-hmm. All customers are facing the same situation of high attrition in the tech staff and a resource crunch. So they all, since they're all facing the same issues, they are more open to the idea of giving you a higher price so that you can also attract talent. We have been able to go back and renegotiate with several customers and increase our prices in several contracts that we have.
But are we able to pass on the entire cost to them, or is it a staggered way?
So that's not a perfect answer because the renegotiations have ranged anywhere from a low of 3, 4, 5% to a high of 30% as well.
Okay.
So depending on each contract, somewhere you're making more money, somewhere you're pretty much recovering your costs. And then there are some contracts we've not been able to renegotiate at all. So it's a mixed bag.
Fair enough. And on the revenue side, sir, the flattest growth we've seen this quarter, 0.5% QOQ.
Yes.
So we are, as Rahul earlier said, that we are, ramping up our sales team, pre-sales team, marketing team. We are, putting a lot of effort in marketing and sales and pre-sales. So those will actually start giving results probably from next year. And we are quite sure, as he said, that we will, at least manage 14 to 15% growth in next year.
Okay, sir. Okay. And currently, what is our current order books on hand in terms of contracts yet to be delivered?
So we don't track order book that way because our businesses are like volume-driven businesses also. In BPM, we have mostly volume-driven businesses. So we really don't have a order book as such. But what we can say is basically the order which we won this quarter. Like this quarter, we had about $85 million worth of new orders. Which will give, definitely a significant growth in next year.
Fair enough. And current last question from me. What would be our utilization today?
Manpower utilization, we are extremely high. If you notice, I mentioned that we have about a shortage of 500 people, billable people. So our bench is very low. Typically, though, we have technically a bench because of the tax season. We have a spike in Q4 every year. Because we do tax processing. And for that, what we have to do is in Q3, we end up recruiting people who have to get trained. So that shows up on the bench. And Q4, they get deployed. So that's an annual cycle that we have. But as such, our bench would be in the range of about 4 5% at best.
Got it, sir. And what is our total
employee because of attrition?
And what is our total employee count today?
11,000.
Okay. Got it, sir. Thank you very much, sir. Thank you.
And we, revenue growth, one of the reasons for revenue growth in past 12 months, we have let go many of the low margin customers. So that also has resulted into, some kind of revenue cut during the period.
But of course, that has improved margin.
That has another impact of improving margin. You can see that.
Understood. And what would be our top 10 concentration? Has that increased then because we have let go of the low margin customers?
No, so top 10 contribution remains more or less same with 1 or 2% here or there.
So how much would that be?
Top 5, top 20 is more or less.
So that would be how much? Around 60%?
27-28% approximately.
Oh, very. Okay. Thank you very much, sir. Wish you the very best.
Then top 10 and top 20 will be 50%.
I'm sorry?
I'm saying top 10 is top 5 is 27%. And top 20 will be about 50%.
Got it. Okay. Thank you very much, sir. Wish you the very best of luck. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Mihir Manohar from Carnelian Asset Management. Go ahead.
Yes, sir. Thanks for taking my question. You, sir, mentioned about the 15% growth for the next financial year. If you could throw some more light on a qualitative aspect as to which segments and what kind of deals do you see flowing into the revenue for next year? I mean, what gives you that confidence of that 15% growth for the next year?
So a couple of things. So as we mentioned, we signed 3 large deals in Q3 of this year. They will all fire or start delivering from next year. So 2 of those deals are in the transport segment, which is doing fare collection. One of them is in the customer service management area. So those, and then we have a strong pipeline of about $100 million, and the bulk of it is in the BFSI segment. So the BFSI segment is the other promising segment for us. So transport, customer management, and BFSI.
Okay, yeah, understood. And so on the margins, any color on the margins for the next year?
So margin we will not, we are still in a planning stage, so at least we know the revenue, but margin we will come back maybe in the next board meeting.
Yeah, the question is how do we improve margins further, and our focus is on, how much we will be able to improve it.
Correct.
Sustaining margin should not be a problem, but the improvement is something where we are going through a detailed planning exercise right now.
Okay. Yeah, understood. That's it from my side.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. Participants on the conference, if you wish to ask a question, you may please press star and 1. As there are no further questions, I now hand the conference over to the management for the closing comments.
Thank you, Asha, and thank you everyone for being on this call. It was a pleasure talking to you, and I look forward to talking to you once again when we have the year-ending numbers in Q4. I wish you all the very best and a good new year. Thank you again.
Thank you.
Bye-bye.
Thank you. Ladies and gentlemen, on behalf of Datamatics Global Services Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.